All right, welcome back to the channel and welcome back to another Stock Talk live stream. Today is going to be a little bit different. No guest, and I don't really have any agenda. So we're just going to chat about stocks. And if you have any stocks you want to chat about or um, questions about market, whatever, throw them in the comments. I will try to get around to them. But yeah, not really any specific agenda for today. And with that being said, though, we can kind of go into what we got coming up over the next couple weeks. And in the next couple weeks, we have, let's see, next week is going to be Tesla. Netflix is going to report. Tesla is going to report. We've got some companies reporting this week. Fuhat, we got BlackRock for you, right? Right. That's your one, right? So we got that going, and you know what? Let me make sure the stream is going here. Content. Boom. Let's see. Pretty sure we're good. Pretty sure we're good. Let's see. Well, I'm sure we're good. I'm sure we're good. So we got BlackRock on Friday, Citi, PNC, Wells Fargo. And then the 25th is kind of when I think things will probably get interesting for me. We got Meta reporting, so that's going to be a fun one to watch, see what happens there. And then the week after that, we got Apple and some of the large tech companies are going to start reporting over the next couple weeks. So we will see what happens with that. I'm kind of at the point right now where I'm not in a rush to really do anything. I'm pretty happy with where I am, and I have a feeling for me it might end up just being kind of hurry up and wait and not do a lot of much. So any word on BRK report? BRK, BlackRock, right? Friday. So yeah, it's gonna be interesting. I'm kind of at the place with my personal portfolio where I'm pretty happy with where I'm at. I'm not really rushing to get in or out of anything. It's just kind of going to be chugging along and probably building up some more cash and getting that sweet 5% interest with low risk money market funds. So yeah, it's kind of getting into that state, I think, where it's going to be investing is boring, and I'm totally fine with that. There has been a little bit of drama going on lately. Let's switch over here. Got the spreadsheet up, and oh man, what is it? PAC and OMAB, I believe. The airports that I had Leo on, and he was talking about Mexican airports, and oh man, did they see some drama? Oh, look at that. Look at that. So, man, that's crazy. And you know what? Somebody asked me the other day, why do I laugh so much in my videos? I think I'm just like, I don't know. I think I'm just, I think it's funny when stuff goes down, I guess. I don't know. It presents more opportunity to me than anything. And this was kind of interesting because it seems like it happened on the news of, now you're going to have to correct me if I'm wrong in the comments, but government kind of renegotiating possibly the fee rates. And that was one of the things when we were discussing these companies with Leo. That was one of the things I was kind of concerned about as being almost like a large outsized tail risk. And then it happened. So that's pretty crazy. We'll see if they actually do get renegotiated. They've had a really, really, really strong bounce back so far. And man, intraday, I think OMAP got down to like, let's see, what was stock? It was crazy. I think it was in the low 50s, like super low 50s. Yeah, let's see. So it got into around, even on this initial sell off, I want to say it was like $52 was low, which was crazy. I didn't bite on it. Still Still need to know more, honestly, and get more confidence in it. But very, very, very interesting. Very interesting that that happened pretty quickly after we discussed it. Um, yeah, let's see. This might end up being a really, really short stream if nobody pops on. But uh, so we got Pack. Let's see. Spy. What do we got? Where's Spy at? 1 year. Yeah, no, let's go to the 5 year. 5 year, pretty much recovering. I think we're down like maybe, is it 6% or so from highs? 9.04% from highs, according to this. So still down about 10% from highs. REITs have taken a nice pullback after the last Fed announcement, and the market kind of started pricing in higher for longer. So we have seen some REITs, especially I think the one that I started adding a little bit more into was ARE, and that got down to in the 90s, I believe, 98 or so. That it got into some price levels where I was pretty happy adding into it and building up that position a little bit more. I think I want to say like my ideal area was around 80, but that's pretty dang de-risked. Already we can kind of see, it's trading at an LTM operating cash flow yield of 9% compared to, its average of like 4.2%. So it's pretty heavily discounted on a historical basis. So we'll see how bad sentiment can get on this one. It's been in a nasty downtrend over the last year or so. But yeah, and then let's see, what's BRK doing since that one is reporting this week. Let me just see. I don't keep up with BRK at all. So actually no. BRK. Oh, is it BLK? Might be BLK. Let's see. Yeah. So it's sitting around 641. Yeah, 641. Up from a low of about 545. So yeah, it's kind of trading in line, honestly, with historical multiples. So yeah, I don't know if you guys probably have a lot more knowledge on this space than I do. I do not really follow asset managers heavily. So let's see, the other thing that I'm pretty interested. When's Amazon reporting? Is Amazon on that? Let us see. Amazon. Where are you? Done. Maybe I'll just Google it. Amazon earnings. Guessing it's going to be within the next month or so. That will be another really interesting one because Amazon is one that I would definitely enjoy adding a bit more into. It's already a decent size holding of mine. But compared to the total portfolio, including indexes, it's not like that massive. So Amazon is one that I would definitely kind of be interested in. And my cost basis right now, I think it's like $95. And if we got to back down there, that'd be sweet. But I don't know. We'll see. We'll see if it happens. Low hundreds, I think I would probably start just kind of shoving some more money into Amazon as my income came in and kind of building that up a little bit more. But it is like 11.5% of my individual stock portfolio right now. So not in a huge rush, especially with the cost basis that I currently have. But this could be one of those where if it gets back down, I would not mind building it out more. And if it got really silly, then you know what, maybe I take a chunk here and there and build it out to a heftier size and call it good. Let's see. Okay. I can't get around to buy Amazon at the current price. I don't know why. Yeah, man. I mean, it can kind of be a hard one to value. I've been looking at just operating cash flow yield on this one, because the free cash flow, the EBIT, the net income can be so just kind of like choppy from reinvestment, capex, growth, investment gains and losses, since they do a lot of like random investments. So I've been tracking kind of operating cash flow yield, and we look at that, and yeah, I put a video out on this one, but we look at the operating cash flow yield, and it's been actually, whoops, over here. It's been pretty dang consistent as far as like a valuation basis. It's ranged pretty evenly between that like 3.5 to like maybe 5%. So maybe 4% around being the median. But obviously we have we have the risk-free rate that has increased drastically. It's up to about 4.23% right now. Actually, I need to update that because that's a static value. And the 10-year treasury, what's the 10-year treasury at right now? So 10-year treasury, because I think that's closer to 5-ish% now. US 10-year, you guys can't see this, sorry, 4.64. So 4.64, dang. So yeah, the risk-free rate's even higher than that. So I've got it at 4.23. It's up about 4.64. So if you're not doing like a spread based off of the risk-free rate, then it's kind of getting interesting. The 5.46% area, I think that's when it dipped down into like the 90s, 80s. And yeah, if it got into that 80s area again, I think I would have to I'd have to add up to it for sure. Yeah, but it's hard because it's not like it's a screaming deal, at least historically speaking. And my biggest concern, not only for Amazon, but for a lot of the higher, I'll say the higher quality companies that are trading at still like historical average multiples, is if we do have rates higher for longer, then there is a good chance that these get re-rated. But man, I don't know. I do still believe that long term, eventually interest rates are going to settle back down. But yeah, if we have a 10-year risk-free rate or 5-year risk-free rate at 5% for 5 years, eventually I would assume that some of these would be re-rated to where the risk premium is a little bit more baked in. So instead of just trading a historical operating cash flow yield of like 4%, maybe it goes to like 6% or something like that, and that would give us definitely some better valuation to add into. But yeah, it might end up that fundamentals catch up in that point, and it just remains choppy. The valuation slowly comes down, and then if we go back into a lowering rate environment, then it takes off from there. So yeah, but yeah, what do you guys been looking at? What are you guys interested in lately? I feel like I'm just kind of chilling with my REITs, chilling with, I mean, who am I kidding? The majority of the portfolio is in tech, right? So Amazon, Google, and Meta are my biggest holdings, and I think combined they make up for about 45%. So chilling with tech, pretty happy with it. Meta is Meta's remained really strong. What's up, Foo Hats? How's it going? Oh, Snap-on, yeah, good company. And Disney, yeah, Disney is enticing. Disney is enticing for sure. Let's actually bring up Disney. I think it got into the high 70s there for a little bit. I want to take I took my starter position, or like kind of not even a starter, just like a solid 3-4% position around 85 or so. So I think I'm probably right around break even. If maybe I'm down, I might be down a little bit. But yeah, Disney is rough. I've been selling off like crazy for the last 2 years now. 3 years. Holy. Man, it's been a rough ride for Disney shareholders, that's for sure. I'm really interested to see how quick they get Hulu to monetization, though. I think it's gonna be quicker than people expect. I know Hulu's been raising prices, and compared to relatively to Netflix, when Netflix came up, I think Hulu's on a faster pace to profitability than Netflix. So that will be pretty dang interesting to see what happens there. I don't think I would add more into Disney, um, unless it got into the, I don't know. Well, I guess it was just in the 70s, like low 70s. Like, yeah, I'd probably add up a little bit, but yeah, for now, pretty happy. Um, it's just gonna be like it'll be one of those where you just watch it play out, be happy with whatever exposure you have, and at least for me, I'm happy with the exposure I have. If it rips and they turn things around quickly, cool. That's great. If it doesn't and the turnaround is a little bit more painful and it goes lower, then you just get more opportunities to add in a little bit. Yeah, let's see. So we got the Disney, Snap on. What is this ticker? No, it's Snap, right? Ticker Snap. Pretty sure. That is one that I've like. I know the business is great. I know the products are great. I don't know if I've looked at the valuation recently though. So that might be. Wait, no, Snapchat. Dear God, no. we don't need any of that. SNA. Lord, please don't let that happen. Yeah, interesting. So, looks like maybe it has been going through maybe a little bit of multiple expansion. But shoot, it's been chugging along nicely, pretty dang nicely. So let's see. Yeah, not really. I mean, yeah, shoot, man, that is really stable. Nice stable growth. What's it done over the last 5 years? So like revenue growth hasn't been that crazy, about 4%. So they're probably seeing margin expansion to get a little bit higher on the net income, about 10.3, EBIT around 7.9. Yeah, I forget. Yeah. So Snap has been super stable. Dividend yield is 2.49. We got like a 12.5, 15. That'd be 17.5. That does not make any sense. What are we doing here? No, that's why. Negative 70. That would be silly. Another 6. Yeah. So here we go. Yields. We need to bring those yields down because this is one that could definitely go through some like multiple expansions. So we do -3, -2, -2, get into a more reasonable yield area. And we say that, maybe the range for their yield might be between maybe like 5 to 7.58. Yeah, that's right around there. So yeah, does pose an interesting opportunity right now. This is what 15% target CAGR, 2.4% dividend yield. This might, hey, this might be one that I need to look into. Maybe do a video on, do a rough analysis, because I think that the multiple expansion could happen even more. Like maybe like a neg 2.5 to neg 2.5. Neg 3, neg 3. I want to do something like this, neg 3.5. Yeah, but in that case, I do want to have a little bit more downside spread, so we're going to do something like that. And we are super close to that base scenario for a 17.5% CAGR overall. Super quick, dirty, nasty analysis. And my mouse stopped working. So British Warren Buffett here. Bacon, what's going on, man? What is going on? Let's see if I can get my mouse working again. Jeez. Apple, what are you doing to me? What are you doing to me? I'm trying to live stream here, Apple. Come on. What the crap? There we go. There we go. All right. So we got SNA. What's their debt load look like? That would be a good one to. What's their balance sheet look like? Dang, pretty. I mean, shoot, pretty solid. Cash short term 870. Hmm. 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 There we go. Okay, well, I was gonna say, nothing's really interesting to me lately, but you know what? That's why you guys come here and you school me and you're like, hey, look at Snap on. And then I'm like, oh, that actually does look pretty interesting. The only thing that I would be concerned with is that potentially, we have, it seems like it's a little bit lower growth, but really stable. 5-year historical multiples are a little bit higher than what they are currently. So it looks like it might be going through some multiple expansion, especially compared to the risk-free rate, but I think it's probably well-deserved. So that's probably a trend that could continue. So I think you could make a pretty dang solid case for Snap-on right now. So that might be one to look into more. Look at U.S. foods. U.S. foods. Dude, I'm not a food expert, Fuhat. I just eat food. I just eat food. Come on. Come on. What's the ticker? Ticker. Give me the ticker or nothing. Ticker or nothing. And yes, very quick and dirty analysis. I am not a financial advisor. None of this is financial advice, as always. So, yeah, entertainment purposes only. Remember that. Just looking over companies, BSing. 1 minute. Man, I can't wait 1 minute for you, Fuhat. Come on. U.S. foods stonk. Stonk. U.S. food stonk. USFD. All right, USFD. All right. USFD. There we go. Oh, man, look at that. Dang, look at that drop off. Shoot. Yeah. All right, let's see here. So market cap, Tim. Oh, interesting. What is going on here? Do not think my data pulling is correct. This looks disgusting. What's going on? Huh. Weird. Well, I looked at it. That's about all you get, Fuhat. I looked at it. CWH slash dividend and got punched. Yes, Dan, we will go back and go over everything just for you because you're worth it, okay? Auditor Dan. Is that your channel name still? Well, everybody go check out Dan Weston's channel. I'm not sure. Is it Dividend? Dividend Dan? Dividend Dan? Dividend. I'm right. Oh man. All right. CHW, CWH. Why can I not? Why can I not say that? CWH. CWH. What do we got? What do we got? Woo. Yeah, another one in a nice downtrend. What the fudge? Camping World. Oh. Okay. All right. So Good Sam. So we got RV, outdoor retail. So like this is going to be highly discretionary, right? And this is mostly RV, like RV segment, right? So yeah. I don't know. So the issue that I have in general with like just recreational vehicles, that whole sector right now, is that I don't know exactly how much demand pull forward there was from COVID and low interest rates. Because even if you look at the used market right now, and oh my gosh, camper vans specifically, I've got a camper van. I do. I have a uh it's built on a Ram ProMaster 1500 chassis, shorter. It's the shorter one, but use it for skiing and everything. Summer stuff as well. But when we were in the market in around 2021, used market was absolutely insane. Absolutely insane. They could not build these things fast enough. There were back orders for like a year and a half. Interest rates were low. Everybody was like massive cabin fever buying these things. And now we're seeing like just the reverse of that. You look at the used market now, prices are getting slashed like left and right, like over and over and over again. Oh man, if this is more of a play on repairs and stuff like that, like I don't know. I'm guessing it. I'm not sure if it's a dealership or if it's more repairs and stuff, but I would just be super nervous because I don't know what the normalization would look like. Like, as good as everything got, like this thing went from 380 to $50. Oh my gosh. Oh my gosh. So as good as everything was, it might get really, 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 really bad. And this is one discretionary area where I think people would definitely sacrifice or get rid of their toy that they got on a whim because they had cabin fever from COVID. So I don't know. Whew. I have looked at Winnebago and Thor, and Winnebago seems pretty solid, but like that's the same issue that I have is like I don't know how deep the normalization or how deep the cyclical pullback from the demand pull forward from COVID is going to be. And you could get caught in a really, 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 really bad position. So I don't know. I do not have the confidence for that, but I mean, we can look at it. Actually, let's just go to income statement because we kind of want to look at revenues just for this one. So revenues, nice, steadily increasing. 2021, 2022 seem pretty solid. Then we see a little bit of pullback, but nothing like crazy. But even though revenues pull back slightly, obviously you can see their bottom line got hit really, really hard right there. So RV repair. Okay. Yeah. Thanks, Kale. Let's see. Want to invest in the companies that retrofit vans for van life. Yes. Yeah. Hey man, van life is fun, man. I love it. It's just my wife and I were just talking about that today of how we're really, really excited to get back. We the ski pass, the independent ski pass that we have, they just released like 50 or 80 more resorts. So we got a whole new slew of resorts in the Pacific Northwest and up through BC. So we're starting to look at all these different ski resorts and kind of plan out trips and stuff like that. So hey man, it's fun. It can be very, very, very fun. So let's see. So we probably got a whole bunch of margin pullback as well on this guy. Yeah, look at that. Just margins collapsing into 2020. So this is kind of worrisome. So from 2018 to 2020, we had gross margins, operating net, and free cash flow margins basically all like declining. Other free cash flow looks like it picked up a little bit, but so we had collapsing margins into COVID. And then we had the COVID boom and a recovery of margins. And now they're starting to downtrend again. I'm wondering, I don't know if they resume that previous trend line, like it can be pretty nasty. So, what is their debt? And I'm guessing their debt is horrible. I'm guessing it is absolutely disgusting. Eh, eh. So you got a lot of big amount of short-term debt. 1.2 billion in short-term debt, and then you got capital lease obligations, and that's probably the majority of their debt looks like it's short-term debt, and that's gonna suck because if they're gonna have to roll all that debt over, unless it's just temporary debt as they're churning through this is CH churning through their inventory maybe, but I don't know. I would be hesitant. Just because I have the belief that this could be a whipsaw of a normalization event for that entire industry. So, which personally, I'm hoping that van prices get destroyed and I can pick up another one and start my own custom build. So we'll see what happens. Okay, let me go through, see if we got any more questions. I think Monster has been pulling back a bit too, right? Also, we had a good day in the market. A lot of things were green. I think Apple and Microsoft are red. So is this the start? The start of the Apple pullback, maybe, huh? We'll see. We will see. Yeah. No worries, Bacon. No worries, man. It's an interesting one. It's an interesting industry in general. I just don't know. I just don't know. I feel like it could be a kind of like a trap. Unless, I mean, geez, like literally COVID was the perfect bullish setup for this industry. I wonder if they'll ever go through something like that again where they get that much demand pull forward. Like, I feel like the normalization could take a long time, but we shall see. What's I gonna say? So Apple, yeah. Apple, Apple started pulling back a little bit more. I think it was down today, while the rest of the market was pretty much up, if I remember correctly. Maybe I'm wrong. Maybe Apple was up. AAPL stonk. Yeah, no, it was down. It was down a bit, down 0.34. And yeah, I mean, still pretty dang close to highs, though. So what do we got here? Let's do no, yeah, 170, 177. Made new highs, 195. So it's basically at the highs, at the pre Jan 2022 highs, something like that. So then Microsoft, these two have just been beasts. MSFT. Let's see. And yep, Microsoft might be a little bit weaker. But yeah. No, and these are two others that are kind of in that same place where they're on a historical basis, they're still trading pretty rich from their historical 5-year averages, and they're gonna have to grow a decent amount to kind of supplement that. If they don't, and we do get rates higher for longer, these could re-rate to something reasonable, and I would say reasonable, and the price action could be horrific. I think they're always going to be kind of a premium on them, or there should always be a premium on them, but who knows, if they run into some regulatory issue, or I don't know. sentiment can change quickly, and people freak out, and things get really, 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 really crazy. So I know my meta chart is going to be messed up because FMP is messed up for their data set on meta, but dang, like, look at that. Let's go over here. We're gonna go over here to meta stock, and I'm gonna share this tab. There we go. And hide that. Boom. Man, look at that. That recovery has just been so quick. 254%. Less than a year. We're probably coming up on we are what? November 4. All right, November 4th, guys. We'll see how much it recovers since a year from the bottom. That'll be interesting. Maybe it can maybe it can squeak out like a 300% recovery by then. Oh my god, but yeah. This was absolutely insane. And remember, if we look at meta, had that great, beautiful negative sentiment around it. And what was their operating cash flow at the worst of this? It was something insane. Let's see, 15. Jeez. And this wasn't even the worst. Like, this is just a data point in 2022. Like, the real low was like over here. Oh gosh, I'm not sharing this type of stuff. So operating cash flow yield right here. Okay, so for meta, this is meta, and the operating cash flow yield got to 15.61% in 2022. But that's not even the actual like low. The low was a little bit further over, right? So I think I remember when I was looking at this, the operating cash flow yield at one point for meta was around 18%, which is absolutely bonkers, right? EBIT yield, net yield was around, I think net yield was around like 9, EBIT yield was around 10. You compare that to something like, I don't know, like what do you guys want to compare it to? We can compare it to maybe like Google, or Google. Let's do Google. So compared to something like Google, and Google is trading right now at an operating cash flow yield of 5.63, right? So to go from 5.63 to 15, that's a massive pullback, right? Like, that's how crazy, how insane meta got. I don't see that happening to like a Microsoft or an Apple or a Google, like that insane, going to 15 to 18% operating cash flow yield. But like, at the same time, it negative sentiment, maybe some slowdown. I wouldn't be surprised if Apple re-rated and was like at, like a 7-8% operating cash flow yield. That's like even that's like a 50% drop. That's insane. So yeah, I don't know. It would take some type of negative spin for, I think, that to happen. But yeah, for me, I don't know, like, Microsoft and Apple are such, let's look at the index breakdown. Okay, here we go. Index breakdown. Apple is 7.14% of the index of SPY. Microsoft is 6.67, and technically I have VTI, so we can throw VTI in here. But like, my exposure is already pretty dang good to these two names just by not owning any and owning a decent amount of the index. So 6.4 for Apple and 5.56 for Microsoft, and 65-70% of my funds are in VTI. So like, got my exposure. I'm only going to buy things that I really want to overweight. So that's kind of how I've been playing this. But yeah, Kale, it was a V-shaped recovery for sure. Man, crazy. We'll see if anything. We'll see what the next one is, because there will be a next one eventually. It's just being able to identify it is going to be harder or easier said than done, right? You never really know. But let's see. Something that I I did add a little bit, added a little bit to Shutterstock. Still super small size. But yeah, so I think my cost basis is rocking around $41 now. And yeah, pretty happy with the position sizing. It's it's trading fairly cheap on a historical basis, but I think there's a lot of fear and a lot of concern around, and rightly so, good concern around Shutterstock for various reasons. So, I mean, I'm not like super confident in this one, but I'm like intrigued, and I could see a realistic way that this plays out well. But it'll be a very, very fun one to watch. Crocs, Kale Crocs. I did add a little bit to my Crocs position, and I had a buy order at like 81.11, I think, and that has not hit yet. I think that's the next section that I would take another chunk of shares, and a decent chunk. I probably increase my position by about 50%. I think that's my current plan. And yeah, we'll see. I mean, it's still SQQQ. We'll get to that later. It's still kind of in a pretty nice downtrend. See what happens. Obviously, yeah, it's trading really cheap. The market does not believe that their revenue and their profitability is going to be stable, and we'll see what happens. But yeah, it's trading cheap. Like if Crocs just flatlines and just grows at 3% with inflation and margins and profitability stay stable, like, look out. This thing's gonna be great. But yeah, let's see. Oh, that was this one, and SQQQ. It's just a inverse short ETF, right? So I don't know. I don't mess with shorts a lot. So I'm more of the opinion that I'd rather have my capital free and save cash up for certain opportunities I'm looking at, and have myself positioned in a way that if tech does bad, I have other asset classes that I think can do good. So I usually do not take any type of short positions, whether that's shorting or inverse ETFs or puts, maybe a little bit here and there just for fun, for fun money. But yeah. Agco. Oh, Agco. I think I remember this. Looked into this. I think Dan brought this up to me. I want to say Dan brought this to me a while ago. And yeah. Agriculture equipment related products. Yep. So yeah, I mean, I have not looked at this one in a while. When I was looking through industrials, I did take a look at Agco and really didn't have anything bad to say about it, honestly. Just never got to the point where I wanted to add it to my positions. So let's see. And obviously, I'd have to do a lot more research to see if this is in an interesting area. Auto DCF kind of says it is, but that could be for a number of reasons. So, but yeah, it looks kind of interesting. So Agco, and what if we normalize this? I don't think it's gonna have normal. Even if we normalize it, it's pretty dang good. Looks like that's close to 20% CAGR. Do I see market crash? No. Imminent, like, for sure. No. I mean, the market's going to do whatever the market does. I don't really give a crap. Market doesn't have to do anything. I think there is, like, I would not be surprised if we had a nice market pullback. I also would not be surprised if the market was, front running to potentially new highs, and then we get a reversal in rates, and then we break new highs, and we go on from there. Like, honestly, nothing would really surprise me. I don't really care. I'm positioned for different situations, and whatever happens. But I'm not betting on a market crash. Something that I'm personally doing right now is saving up more cash, but that's just for my personal allocation. I'm not like super heavy cash allocated either. I'm vastly majority is in equities right now. So, have I seen what Barclays said? No, I have not. I have not seen what Barclays said. So, I think a lot of times I ignore a lot of stuff because it feels like at any point in time you can find about anybody that will say one thing, and then you can find somebody else that will say the exact opposite. But let's see. I'll Google it, and Barclays. Let's see. What is there anything in the news? I did see there was one. Was it Barclays, or was it another bank / firm that said 20% pullback in the market? There was a pullback. The Schwab market corrections. No. JP Morgan. That's right. Some guy from JP Morgan was like 20% market pullback. You know what? Cool. If it happens, great. Also, I think if this guy was accurate all the time with his predictions, he probably wouldn't be on CNBC. He'd probably just be chilling somewhere with his billions and billions and billions of dollars. So, like, I'm sorry, I'm skeptical about that stuff. But really, it really wouldn't surprise me. Like, because if we do get rates, like if the market fully digests rates higher for longer, growth slows in some of the mega caps that are in the SPY, right? Apple, Microsoft, basically just two, and we have those two re-rate a little bit, like that could make a huge difference. But typically what happens is a lot of times you'll see sector rotation within the markets, and the SPY itself, tech might do really bad, but other sectors might pick that up, and it might even out a little bit. But we are pretty overweight, so in certain areas right now. So, I mean, obviously tech makes up for a large majority of the market. And let's see if we pull up the share this tab. Do we have percentages? Full S&P 500. Let's see. Yeah, so tech is making up for what, probably like at least 20% of the market, I would say, something like that. But yeah, we'll see. We'll see what happens. I'm not really worried too much. I actually would like a market pullback for sure, because if we got an overall market pullback and on top of that we saw a little bit of weakness or something like that from Amazon, like that's when like opportunities can get really, really, really juicy. So if we get overall market weakness along with some like, a bad report or two bad reports from Amazon, from Google, like I think that's when those buying opportunities really, really tend to present themselves. So we'll see. Well, guys, I'll give you a minute to ask any more questions. It's been fun. I usually do not do solo live streams, so this has been actually pretty dang fun, pretty enjoyable. Took a little bit for people to get on, but hey, you know what? It's been good. And I got to head out here soon though. So Yeah, with that being said, looks like we are pretty much out of questions. I hope you guys have had a great week, great day. Continue to have a great week. And yeah, we will catch you in the next one. See you later.